Hey everyone, it's Mike, and welcome back to the OrderFlows absorption course, module number 2, Understanding the Players. Now, before I begin, a brief disclaimer: this presentation is for educational and informational purposes only, and should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that could be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. All right. Big traders, institutional traders, however you wish to describe them, are the boogeyman in the trading world who smaller traders like to blame when everything goes wrong. But nowadays there are so many different types of traders that can move large size in the market that lumping them together devalues their worth. And what do I mean by that is, now you have these firms that I wouldn't categorize them as large traders per se in the sense of real money accounts. They are large short-term traders, scalpers. I'll say scalpers, but intraday traders that can move a lot of size. Now, even though they move the size, I would not categorize them the same as I would a big commercial trader or a big bank, because their timeline of a trade is much different than a more longer term trader, a real money account. Now, trading nowadays is anonymous, right? On the screen, you can't see who's buying and who's selling. It's impossible, right? You don't know the actual buyer, the underlying seller. Back in the days of the floor, you had an idea sometimes who the underlying customer was, depending on which house they're trading through. But on the screen, you don't have that luxury. You can't even tell if it's Goldman Sachs buying or selling. You can't tell if it's JP Morgan buying or selling. You can't tell if it's a Cargill, or a Stat Oil or BP that's selling gasoline or oil. Or you just can't see that. So with order flow, now you get to see the volumes now as opposed to a normal bar chart, and you can't guess the actual underlying trader. Down to what company is working for. But what you can ascertain is areas where big institutional players are active, right? And to me, I think that's one of the real benefits of order flow, that you can sort of make an accurate assessment of what type of player is active in the market, rather than just looking at a bar chart and not knowing, is there heavy volume, like here, right? There's a prominent point of control down here at the low. It's telling me that there's institutional activity at this low, that I could be fairly safe in buying this low here. Now, at any given point in time, there are many different buyers and sellers in the market, trading different time frames, all having different opinions of the market now versus sometime in the future. And not everyone trades a 1-minute chart, not everyone trades a 30-minute chart, 4-hour chart, or a daily chart. There's every trader has a different time frame, has a different outlook of the market, where it is now versus where it is in the future. And that's sort of what makes the market. And it just it kills me sometimes is you talk to retail traders, especially you see this a lot in the forex world. They think everyone is on a 4-hour chart. They think everyone's looking at they think everybody in a bank looks at a daily chart, then looks at a 4-hour chart and a 30-minute chart down to a 5-minute chart, and then makes a trading decision. That's not how it works, and sometimes trying to convince them otherwise is it's like banging your head against the wall. And you have to realize that there's some people, they don't even look at a chart intraday in the sense of trying to make a trading decision. They're looking at a daily chart. And then there's people that look at a 1-minute chart, don't even bother with a daily chart. So, don't sort of fall into this trap that, oh, this is how everybody does it, and this is the way I got to do it because so and so said it like that. And you have to have an open mind and realize, start talking to other traders, have interaction with other traders. But what I mean by that, please, don't go to a message board, a forum, or something, and talk to some anonymous person on there who won't even hides behind a screen name and thinks he's some market wizard when he's not, and he's probably just trading on sim. Usually the obvious way to tell is when they think they know everything. The successful traders realize how little they know, and to me that's sort of the the red light, so to speak. That's why I don't hang out in trading forums. Even though I have the OrderFlows traders forum just to post charts on, but you go to these message boards and everyone thinks that they're the world's biggest trader and the world's greatest trader. They're not. The real successful traders don't have time to be hanging out at message boards, and oftentimes the people that are on those message boards don't know how to trade. That's why they go to the message boards. Then they think they know stuff. People agree with them, and all of a sudden, next thing you know, they think they're a market wizard. You have to meet actual traders. Go to conventions, speak to traders in person, face to face, get to know them. Is it free? No. You got to spend money to do this stuff, but really, if you want to be successful, you got to put yourself around successful people, real people, not anonymous people on the internet that, what's your name? Oh, my name is Big Lips 99 on futures.io or whatever. You have to make an effort to meet people, right? And nowadays it's hard because, everything's on social media and people don't have that interaction anymore, going places. So, I say if you ever have a chance to go to an expo, a trading expo or something, FIA, the Futures Industry Association has these shows every year, usually in Chicago and some other cities. Try to go there, and meet people. It doesn't matter if you're just a small time trader. You go there, you meet someone from the CME, you get a free T-shirt at least, and and it's from there that you get interaction with other people in the trading industry that can really help you improve yourself. So let me ask you, which one do you think is the short-term trader? Is it this guy that puts his seeds in the ground and lets it grow slowly? No. Is it the guy that is just putting his bait in the water? No. It's most likely this guy, right? He's got the computer out, right, sitting on the phone, ready to blow his brains out. Short-term trader, right there. Don't be that guy. You want to have a more relaxed and enjoyable time trading. If this is you every day with a gun against your head, give up trading. Honestly, you shouldn't. There's a lot of other activities to do rather than trade. So, what's the difference really between institutional traders and retail traders? Well, retail traders take trades based on profit potential. What's the winning percentage or profit potential? You can see them from a mile away. They're the ones that talk about, well, I can only take a trade if it's got a 3-to-1 risk-to-reward ratio, and it's got, I've back-tested it 20 years, and it shows 82.1% win percentage. Oh, 79%, I can't take that trade. It doesn't meet my requirements. Come on. Institutional traders take trades based on risk evaluation. What can I lose is what they're asking. They're not saying, the trade will take care of itself. They understand that. What they're really doing is evaluating the risk. Can I lose on this trade? Yeah, okay, I might lose, a little bit initially, or conditions might change. It might start losing, but they know that what the upside is, right? They're not concerned that, I don't know if it's going to meet my 5-to-1 risk to reward ratio, so I can't take that trade. No, that's not how they think. And that's to me, that's one of the big differences between retail traders and institutional traders. Retail traders rather get so caught up in the percentage or in the risk to reward ratio that they miss out on a lot of trading that's going on in the market. And when you look at a chart, you should always be asking who's buying, who's selling, right? We're up here at a high. You should be asking, do I think institutional traders are buying up here, or do I think they're selling up here? These are the questions you should always be asking. If you think that retail traders are the ones buying up here versus institutional traders selling, okay, well, whose side do you want to be on? You want to be on the institutional side. You don't want to be on the retail side, the herd mentality, right? Ideally, you want to be on, quote, the smart money side. But you have to be able to determine who's buying and who's selling to understand whose side you're going to be on. Now, while it separates retail traders and institutional traders, I then further define institutional traders. and I'd break it down between long-term traders and short-term traders. And like I said at the beginning, right? People just sort of lump in everything that's not retail trading into institutional trading. But even within institutional traders, you have long-term traders, short-term traders. And what do I mean by that? You have these shops now that are basically very big local shops, in the sense that a trader in there who's, in the old days, he would just be a local on the floor, and you'd just he'd be trading his 500 lots of corn, which normally would fall under, you would think that's it's 500 lots of corn, he must be an institutional trader. Well, no, he's a day trader. He's got some leverage, he's got a big account, but I wouldn't necessarily consider him an institutional trader. That's why I break it down between long-term traders and short-term traders. Long-term traders are going to be the ones that are buy and hold, or sell and hold for a long time. Where short-term traders can buy in the morning, sell in the 2 hours later, right? They're in and out based on market activity. And short-term traders trade because they need to. They tend to trade more aggressively. They want to get in a position now. They're more prone to getting trapped in the market. Long-term traders can wait, right? They tend to trade passively. They're willing to wait for the market to come to them, and they don't get trapped very easily. That's not to say that long-term traders don't get trapped. Well, of course they can. They're human, and many traders don't differentiate between the different traders, right? It's almost as if they think everyone looks at the same chart. Like I said, long-term traders have vastly different market outlooks than short-term traders. Long-term traders have a macro view. Short-term traders have more of a micro view. They may take into account macro data, and what do I mean by that is, they can trade around a number, whereas a long-term trader is sort of, I'm not going to say oblivious to a number, because he will react accordingly if the number's out of line, but he's taking more of a long-term view than the short-term guy. The short-term guy will be out by the end of the day generally. So again, this is why I like delta charts. This is a delta footprint chart, a linear delta footprint chart, and you can see how everyone is just selling, right? You can see the selling. Now you could see this on a normal volume footprint chart if you're familiar enough with it. I think it just stands out a bit more on the delta chart, where you could just see everyone's hitting the bids, and it gets down in here, and you could just see how, for me, I think it's very clear. Maybe I've looked at these charts long enough where it's just sort of forming this base, and you can see how there's big passive bids, even though here everyone's just hitting the bids. Okay, it's eating through these big passive bids here. 1400. These are delta, so this is the difference between the volume traded on the left versus the volume traded on the right at that price. It's not diagonal, it's linear. And I could look at diagonal delta charts, not be that much different, but what I like to see on this is how it's eating up through, and sort of leaves this footprint here. So you can see minus 1400, 500, 400, 400, 500, 900, 100, 400. The actual volume numbers are probably bigger. But then it gets down here and starts turning these green bars, right? You look at these point of controls. They come up, market comes up, puts in a little higher volume here. It looks like it's about to take off, but boom, gets more selling. But you have big passive buyers down here, right? Point of control is lower, so you're putting in a lot of volume again down here. Pops up, looks like it's ready to pop. Not quite yet. Gets down in here again, heavy volume. Point of control down here towards the bottom, and you look at this rest of this bar. It's green bar. Everything's on the offer side except this 175, the 75 contracts here. But it's just what I call it, sucking them in. It's like they're almost setting this trap for sellers to come in here, sell as much as they can, sort of give it this little fake bounce, let the sellers come back in here, sell some more down. But they're just all waiting in here. Now, this is where it gets interesting. So here, look at this volume, 52,000. So this is a 5-minute E-mini chart, 52,000 here, big negative delta, okay? Get this little green bar, a little bit of a bounce, 30,000 volume, still heavy. Bounces up green, positive delta, okay. Sellers come in, boom, hit it down again, minus 3,800 delta. But look at this volume, it's a lot lesser. It's 27,000. So you went 52 22,000, 30,000, 27,000, and you get down here to this low, 21,000. Okay, positive delta, 1265. 1, 2, 3, 4 bars. Volume is getting lesser. So, even though you have these green deltas in here, positive delta, there's still selling pressure, but it's getting lesser. Right? It's getting lesser. You get a little bit of bounce. There's another push down in here, a little bit of a bounce, but the overall trade that's happening is getting lesser and lesser. Then you get down here, there's delta 48, negative 48. That's nothing in terms of, normally your bars have, 1,000, 1,500, 2,000 contracts trade. Get a big volume in here, 31,000. Okay, it's the only time it's been bigger than that is when you had this bar here, 52,000, and it just hangs out here, right off the low, right in the low, point of control right in the middle. So all that selling, it's like we bounce up a little bit, more selling. It's absorbing. All these sellers are coming in here, but there's buyers absorbing that. Right? Look at that. Delta is only minus 48. It might as well be 0. And it's just you could just feel it, right? You could just feel how it's trading a lot of volume, but market's not going anywhere. It's not going any lower, right? Instead, it starts ticking up. You get the higher point of control. Bar closes, comes back down. Still holding this previous point of control here on the low. It hits this pocket here. People are still selling it. Maybe we could go lower, just as here, right? You hit the low, everyone's coming in. Oh, new lows. You just hit a new low. 1, 2, 3, 4, 5, 6, 7, 8, 9 new lows. But you trade 31,000, doesn't go any lower. Volume lightens up here, 18,000. Tries to make this push right here down 23,000. It's decent. It's not high. It's not low. It's closer to higher than lower. But there's people in here absorbing it. You could just see it in here, right? You got the lower point of control than the previous bar. It's a green bar. This is these two point of controls. This bar and this bar is something I talk about in the point of control course, actually. Very bullish, very bullish. So you got 1, 2 very bullish point of controls in here that often acts as springboards. And you can see how the market went from 98 all the way up to, over here, it's trading 10, 12 already. But the signs were in here early that there was, the longer term traders coming in here looking for an area to buy. How do I know it's longer term as opposed to shorter term? Well, it's a fine line, honestly. It's, for me, when I'm looking at lows, I'm looking for areas. That's where a longer term trader is going to be buying probes, basically. The short-term traders are the ones that often probe it, trying to see, how far they can push it. Okay? But the long-term trader is sitting in there. He's just lying in wait. Honestly, the long-term trader is buying all the way down here. These big volume numbers in here, this from here, 600, here, 1,400, 700. They're all working bids in here, the long-term traders. Then they start coming in here, right? Notice how we're putting in heavy volume and the market's not moving. To me, that's the sign that you have longer term traders in there, because they're the ones absorbing all the activity. Short term traders would be coming in, lifting these offers. This area in here, this is where I think the shorter term traders are coming in, like this big run up right here, all offers being lifted. Down in here, this is where the long term traders are. So the most important part of market understanding is recognizing when different time frame participants are active. Markets are dominated by short-term traders who are more focused on price. Longer-term traders realize that the markets have moved too far away from value. That's when they become active. They come to the market to compete alongside the short-term traders for opportunities. What's important for you to understand is that the market's balance has shifted. It's no longer dominated by just short-term traders, right? The big short-term traders are the ones that move the markets intraday, but the long-term traders are the ones that help define the trend. Okay, and so don't fall into the trap of thinking that it's only the day's range is defined by the the what do you call it? The day time frame traders. It's not. It's actually helped defined by the long-term traders. So when you have the long-term traders competing with the short-term traders for opportunities, that's when you see the market start to trend. If you get down in here, all right, short-term traders are thinking, we're not going any lower. Long-term traders are here. They start competing. But the long-term traders that want to get long, they're competing with the short-term traders. Forget about the retail traders. Retail traders don't make much of an impact, honestly. Their volumes are quite small relative to the large short-term traders and obviously the long-term traders. So when the long-term traders and the short-term traders, institutional side, are competing for the same prices, that's when the market starts to trend. And again, you can see that in the order flow if you know what to look for. It's difficult to isolate a trade being done by a short-term trader versus a long-term trader, but when you take into account market structure, it becomes clearer, right? If you just look at a bar, you're not going to be able to determine. But when you take a market structure, okay, we come into a low, seeing buying, if you start seeing aggressive buying, if I was looking at a volume footprint chart, I probably see some imbalances occurring, at certain areas. Then I know, like I said, short-term traders tend to be more aggressive than longer-term traders. Longer-term traders start buying, they bid over, they start lifting the offer bid. What I mean is market 6, 7, they pay 7, work a bid at 7, because market's now 7, 8, right? So they buy all the 7s, and they turn it bid, and they see, it's 8 trading, they buy all the 8s, 8 bid now. That's what causes the market to move. Now, the bigger short-term traders, it's 7, 8, they buy the 7s, they buy the 8s. They don't necessarily turn it bid and sit there. They're just more aggressive in the sense. Now, who is the longer term trader? Well, it's a position trader, right? It's a commercial, it's a portfolio manager, it's real money accounts. What's a real money account? It's going to be a pension fund, it's going to be a sovereign wealth fund. You watch Billions and you hear, about the sovereign wealth funds investing in funds. Yeah, but also the sovereign wealth funds also have their own trading departments as well, where the traders call in and place orders, take market positions like that, and in addition to giving money to Bridgewater and all the other big funds like that. So a long-term trader doesn't have to trade a market on a given day, but when he does, he can be more cautious and passive, right? He can let the market come to him. He doesn't have to get filled today, right? I would see it a lot, talking to the equity guys. Oh yeah, this is a JP Morgan. They have an order from, this real money account to buy a certain stock. Well, they buy what they can today. They don't want to push the price. Okay, if he doesn't get filled today, they're just going to work it tomorrow. I would be there talking to one of the traders there, and I'd hear his buddy on the phone say, "Okay, so we'll just continue to work that bid at such and such a price, or continue to work that offer at such and such a price." If you don't get filled, fine. It's they're willing to wait. Then they readjust and say, "Okay, well, yeah, let's lower the price, or let's raise the price of our bid." So they're also trying to capture market generated opportunities undetected. So what I mean by that is, that's what all these execution algos come into effect. They're trying to get execution alpha, right? They're trying to save. They know that they have to buy a certain amount, and they don't want to impact the market, right? So they're going to get a little tricky with it, work bids, lift some offers, and like that, they're trying to get a good price on their fill, a good average price. Now, when the longer term trader becomes a little more anxious, he starts becoming aggressive, and his actions start to be seen by the short term traders, who then also start to trade alongside the long term trader. So, if you're looking at a bar chart, okay, this is just your normal candlestick crude oil chart. Well, are long-term traders active? Actually, no. Why? The way you can tell on a bar chart is that the market's going nowhere, and you got short ranges. Market's opening and closing at the same price. Basically, a lot of those doji candles, in small ranges, small real ranges. Between the not necessarily the high and the low, but the open and the closes. Now, here's soybeans. You can see how big down days, big ranges, big red. That's how you can tell long-term traders are active, because they're the ones pushing the market. So long-term traders view buying and selling differently, right? So when there's long-term institutional buying at the end of a downtrend, that's often enough to start an uptrend. And traders are happy to start buying and see a trend upward because they like to buy low and sell high. Okay, they won't get in trouble for making a profit in that sense. But when it comes to selling, they have to be more cautious, right? Long-term traders generally are always holding inventory and wanting to sell at opportunistic prices, right? If the market pops up, right, they want to sell before the market drops off again. But if they sell their inventory too aggressively, the market can drop quickly, and their profit opportunity will evaporate as prices revert back to value. So at highs, long-term traders are more cautious but get aggressive once prices start to go lower to a point. Right? This doesn't mean prices start dropping, they're going to stop. No, they might get aggressive and then stop. But usually when they sell, it's to take a profit. But at least in stocks, in futures it's a little bit different. Whereas they can get short, but that's sort of a different aspect. Unless they got some major piece of information, that they think the market is going to drop over time. Really, it's bizarre in the sense that a lot of these real money accounts are really just buy and hold. Long-term traders, buying and selling is going to change the overall supply and demand paradigm in the marketplace. It's just because of their size, right? It's funny in the sense that it doesn't. Okay, so what happens? So for example, crude oil, right? When I say British Petroleum, what they're doing in the market is going to change overall supply and demand. What it does, it doesn't. I don't say it shifts it, in the underlying sense like that, but it's people see that and changes the perception in the marketplace of what the overall supply and demand is. It's not like they're turning off spigots to control the supply, but if they're buying a lot, the market might perceive that, oh my gosh, you got the big petroleum companies are buying oil. What's going on? Is there a shortage? Going to be a shortage like that? But that's how it works. Okay, so when you're at a high, the question you always want to be asking: are we going higher, or are we going to start selling off? And you want to be looking for the signs of either one. So, this is Euro currency. It's a 5-minute chart. So you got this big bar here, right? 1,500 in volume. This is 5 in the morning, Chicago time. It's 1,500 contracts at 5 in the morning, 5:30. You got some heavy volume in there. Look at this, 622 in the footprint, 278 at this level, just below this high. We came off a little bit, and then boom, made that new rally, took out those levels, made new highs, got a divergence up here, came back up here, tested it, and then sold off. So what you want to be asking is, when you're looking at this high, is there a sign that we're going to go higher? Right? We took out the highs, made new high. What's going to happen now? We start coming off here? Are we going to rally back up here and take out this high? We come back up here, we test it again. There's volume. It did go bid there actually, but it didn't trade, one tick above. But then it started selling off. So what's the signs in here? Well, first of all, you got this big volume in here, right? This one stands out. 1523. Market didn't really go anywhere. Didn't go higher. What you had is, someone bid, a lot of volume here, 622. So this is going here. You got the big sellers coming in here, selling the heck out of this market. There was a buyer here. Maybe he's working a cash. You don't know. Something against it. But nevertheless, heavy volume, market should be going higher, right? You were trending up, got big volume, market starts going down. Then boom, you get big volume bar, push up. But look at these deltas, 37, minus 37, minus 154, minus 60, minus 96, minus 215, minus 90, up here at this high. Now, we'll talk about this in a second, but sort of one of the things you got to be watching for is, when you're making new highs, how is the selling occurring? Okay, and what do I mean by that is, are is there a lot of distribution up here? Is there inventory being sold? Okay, and when you got up here, there is 278, 622, so 900 contracts going through right here. Okay, just before the high. All right, fair enough. You get up here, look at some of these. I start to look. The first place I would look is the point of controls. See if there's anything really major that sticks out. Honestly, these are kind of averages, kind of average point of controls. 155, 98, 125, 103, 195, 141, 147. Then I sort of look at where they're sort of occurring. You got this prominent point of control up here, which is indicating to me already supply based on this point of control. And I start looking down here at the deltas. Okay, what I want to look at, are they positive or negative? They're negative. How's the volume? It's good. It's above average. 1100, 1000, 958. Other than this one bar here is 1523, you don't really see anything above 900. Even in the bar that you broke up here is 900, but everything else is, relatively lesser. Here's earlier, an hour earlier, you got a couple bars with some 900s, but everything else is 500, 600. But you're trading heavy volume up here relative to earlier. I'll say it's heavy volume in the sense that, oh gosh, we haven't traded this volume in days. No, relative to earlier, 1000, 958, and market's not really going anywhere. It's just going sideways. So I know that there's volume being transacted, and it's slightly tilted to the negative side. 154, 60, 96, 200. Then boom, you get the big push here. 1954 and strong negative delta 194. Right before it drops off. This is that everyone, to me, this is up here. You have the longer term traders selling their supply, and then the short term traders are coming in here, and that's contributing to this volume here, and we get that push lower. When you're trading at a low, that's the same thing. What's going on in the market? Like, what do we know, so to speak? You hit that low, we rally up, come back down towards that low, prominent point of control. Okay. What's going on with the volume? You got the big volume push here, 2,900, 3,800. But look at this. Positive delta, positive delta, positive delta, positive delta, positive delta. You're getting positive deltas as you're making new lows on fairly strong volumes, right? 2,900, 3,800, 2,600. Finally you get that little bit of a pop up. So I know that, every time we're coming down here, we're pounding through here. There's counter buying in here. People lifting the offers. People lifting these offers to turn it just positive. Positive. So there's buying coming in here. People are saying, oh, it's just a matter of, can that buying, is it enough to support the market? Is the selling that's happening, is it enough to push the market lower? If it's not, what's going to happen? The market's going to rally, right? So every time it comes down in here, you have more sellers in here. What I mean by more sellers is, on the offer, right? Look at these. Why do you have positive delta? Okay. So like, for example, this bar right here, okay, compare 314, right? Look at these offers, right? 254, 200, 499, 363, 286, 196. You got very healthy offers, but there's people buying those, right? So you got people offering it down, but people are still buying it. You got very strong volume here on the bid side, 371, 200, 198, 272. So you have people working bids, but they're also not afraid to be buying these offers. They know that we're coming into an unfair low, an unrealistic low. Finally get the bounce up. And then down over here, we got the prominent point of control. Look at this, 198, 131. They're buying. This is their, for the long-term trader, this is their, oh, thank you for coming back down here and giving me more opportunity to get long before the market pops back up. Look at these volumes here. It comes down, the heavy volume here. Then it's just, sort of average volume gets really dry. As you come down here again, you're making this next run down here at this low. Do you think this low is going to get taken out on volume of 500, 700? Most likely not. You come down here, you're pounding through this 2,900, 3,800. Even here is 2,600 as you make that new low, but here it's, it's like 1/5 the volume. So people are down, and the sellers are like exhausted. Oh shit, man, we've been selling it down in here. I had to cover here. Let's try it again. Let's take another run at the low. They're getting tired. And then they're met with the big passive buyers down here. You got the prominent point of control before the market rallies back up. Here you got some positive deltas, but nothing major. 36, 47, 8. These are relatively small positive deltas. In here you get the nice big positive delta with a nice big positive volume before it pops right up. So when you get down to a low, ask yourself, what's the sign that we could go lower? You always want to be looking for signs of lower activity. And, just the first place I'm going to look for is the deltas and the volume for the bar. 2,400, okay. Made a new low, 3,800. Okay, small positive delta. You got a divergence. Then it's just going sideways. 121, 14, 89. I'm talking in absolute terms. 104, 27, 19. I'm not getting too excited about this market rallying on such small positive deltas. 19, 14. Yeah, 104 here. Even the negatives are still kind of small. To me, it looks like a market going sideways. If we come back down here and test this low, take out this low, I think it can go lower right there. I mean, obviously it does. Boom. That's where you get the big volume surge right there. As you take out the low, maybe some stops got triggered. Then here it looks like it's starting to bounce up a little bit. You got this bearish prominent point of control in here. So I look what's going on. Why do I got a big positive delta, 348. It's your biggest positive delta ever, or not ever, but on this chart at least. Well, why do you have the positive delta? It's because I know that there's some passive sellers in here, right? It's a prominent point of control, so it's telling me that there's resistance in here. I look at the chart, 101, 143, 76. Even at the top, 31. So I know that there's sort of this pocket of sellers up in here. That's why you have a positive delta on the red bars, because market starts ticking up, but there's some sellers in there that are absorbing all the all the buying that's going on. Then I sort of see this market go down, negative delta here, negative delta here. You got positive delta. Point of control is the bearish point of control sign, talk about in the point of control course. And then the market just drops down further. Again, I'm not sure I'd be getting short right in here. But if we're going to take out this low, I'd be looking for a breakout lower. Take out this low, also again, be looking for a breakout lower. Long-term institutional selling takes longer than buying, okay? Long-term institutional traders are more cautious when it comes to selling than buying. Think about it, right? If you sell too quickly, and supply and demand paradigm, people's thoughts are going to shift, and other traders are going to pick up on it and join the selling, and then the market can start trading lower, and eventually everyone's going to sell at lower prices. It's like, if you've ever sold stuff, for example, on eBay, okay, and it's something that a lot of other people were selling. It's what's called the race to the bottom. And say you're selling, a Chicago Bulls coffee mug, right? And everybody else is selling the same mug. Well, to get more sales, you're going to lower your price. Well, then eventually everybody else starts lowering their price to capture those sales. And the next thing you know, the coffee mug you're selling at $15, everyone's now selling at $9. And it's the same thing in the markets, right? If you start selling, dropping your prices a little too aggressively, everyone else is going to start catching on to that and start lowering their prices aggressively. And you're no longer be able to sell at such a nice yum profit. You got to sell at close to break even, which is not really a good business model, but a lot of people do it. And you can see up here, right? This is crude oil, so we're at this highs up here, okay? And this is what you like to see, the market going sideways. If you got some selling to do, right? You don't want the market to immediately start selling off, right? You want to try and sell as much as you can, as close to the high as possible, right? It's almost like a game for traders that are trying to move size is, how much can I get off without moving the market? Now on a footprint chart, unless you're really in tune with analyzing the volume, I suggest going to a delta chart and seeing, take a look at how it's transacting, okay? And what you're looking for is, is there offers? Is there offers? Now, you're thinking, well, it's only 10 and 15 and 22. That's not much. Again, this is a delta chart. It's taking the delta between what was traded on the bid, what's traded on the offer. And, what it's telling me is, up here at the high, it's mostly trading on the offers. So there's supply up in there at the high. If we were going to take out this high, well, first of all, we'd be on the other side of the high, but, you would probably be seeing some bid, market going bid over, right? Market, traders lifting the offer, turning it bid. Instead, it's running into resistance at the tops of all these bars here, before, heading on down where you get the bar here like this with pretty much everything traded on the bid side right before it goes lower, and I'll look at the volume, 8,000, right? That's your push. That's all the other traders coming in, finally realizing that there's somebody up here selling, some supply up here, and coming in and joining in the selling and pushing that market down lower. There's a lot of the price action traders, this is where they're getting shorted in here, but if you could read what's happening, you could be getting short, 10 ticks above that area before, down here at 15, you'd be getting short at 25 and 30 instead of 15 and, well, I don't even want to say 20, but around the 15 area, you're getting in much earlier. Now, the reason long-term traders trade highs and lows differently is they have to, right? Long-term traders are going to be more inclined to place offers at high prices rather than hit bids, so as not to show their selling pressure to the market. This passive selling can be detected in the order flow. And they're more inclined to work offers into a rising market above the current price so they can take profits on inventory. They don't wait for the top to be put in necessarily before selling. They know there's going to be people buying, okay? So they're happy to oblige and sell it to them. So these guys, they have their profit target in mind from, however long ago, and they have offers in the market. And for example, like the market's going up, right? They're the ones. That's why you see sometimes, when you're making new like life of contracts highs, you think, well, there shouldn't be any resistance up here. But then you look at the depth of market, and then you look at the footprint chart, and you're seeing, wow, you're trading 5,000 contracts here, 2,000, 3,000 here, 3,000. What's all that resistance coming from? That's the long-term traders, and it's important to be able to realize that in a rising market, that's when a lot of retail long-term traders are going to be selling, because it's easier for them to sell in the rising market than it is in a falling market. Now, I sort of touched on this a little bit earlier, about 10 minutes ago, but I think I might have confused some people. But long-term traders are often the traders responsible for the way the day's range develops, right? When they're active in the market, often they will have a wide range. The market will have a wide range. If they're absent, the market's going to have a narrow range, right? Everyone talks about these narrow range days. If you've never read Toby Crable's work, I suggest get a copy of it and read it. It's the narrow range days. And what makes it so powerful, right? And Toby Crable was famous for the opening range breakout, even though people like Larry Williams and Tom DeMark had been working on it a long time before that. But they worked all together. They all know each other, actually. But what makes it so successful is when you have these narrow ranges, it's because the long-term traders aren't active. And then when you start breaking out, that's when the long-term traders are active, right? That's what's causing the trend, right? Because you go from the narrow range day to expanded range days. That's when, it's like a rubber band, right? You wrap it around your finger, it gets narrower and narrower, then you let it go, then it unravels and takes off, right? And that's how the market is. Once the long-term traders start participating in the narrow range, they're not there. So It's important to learn to recognize their activity in the market in the footprint charts. And the easiest way to detect the long-term traders is through an increase in volume. So what's going on up in here, right? This is E-minis. Again, all the charts in here are 5-minute charts for continuity's sake. So look, I mean, you're making the new highs, 42,000. You're up here at your high, 29,000. You're still trading relatively decent volume in here, 21,000, 16,000. And it sort of dries up a little bit. 10,000, 16,000 again. You make that push. Look at this volume up in here, 1184, right? This is what I'm talking about, right? When market's making new highs, look to see, if there's that volume, right? On this move up, you can see it in here, this area up in here, 2,500, 3,600, 3,100. Market's chewing right through that. Even up here, you're seeing 2,000, 2,000, 2,000, 2,000. Normally, right, during the regular trade, you're seeing around 1,500, 1,000 to 1,500. But this is the supply, right? You got the longer term traders, they're layering in their offers in here. And you can see it even up in here. You trade 1184 on the high. All right, normally your high of a bar, you're looking at volume of 100, a couple hundred, if that even. But there's someone in here with supply. The market starts coming off. Even here, you're thinking, wow, look at this. All positive delta, no min delta, nothing, zero. Max delta 3,000, final delta 1912. The reason you have it is because you have a lot of supply up here near the highs, that people are lifting these offers. You got 388 versus 640, 0 against 1184. So you know that there's supply up in here. And then here, okay, big volume, big delta. Why isn't the market going higher? Why is it all of a sudden trading lower? That's not a good sign. And then here, you're getting some selling imbalances coming in, negative delta. Here, small, again, an inside bar, narrow range. And then people start coming in and realizing, hey, you know what? We're sort of at an unfair high. Start selling. Volume starts picking up as people, the long-term traders, they've been smart, right? They're the ones selling up in here between this high and this high. And then once you come back in here, notice how fast it moves. Big bar down, very fast, heavy volume. Remember, the long-term traders are often going to be the ones that cause trends and keep them moving in a direction. It's sort of like, adding lighter fluid to a fire. You start the fire, and it starts, it's okay, but you want it to move faster, so you add more lighter fluid. And if the long-term traders are participating in the trend, it's going to gain strength, right? You're adding more lighter fluid to the fire. If the long-term traders stop participating in a trend, the short-term traders have to pick up the slack. And when the long-term traders are active in the market, they're buying as the catalyst to push prices higher, or they're selling to push prices lower. And what do I mean by that is, a trending market with long-term buyers, right? You're going to be looking for supportive buying. You're going to be looking for aggressive buying. Where's the volume? Boom, 27,000, 22,000. Deltas, 8,000, 4,000, 2,400. Is the market going in the direction you expect it to with those numbers? Yeah, it is. It's when the market stops going in the direction on those numbers that you got to be aware of, okay, are they stepping back now, or what's happening? You really have to think, as a trader, you got to think about what's going on and put it together. On a nice trending market like this, right? Boom, big green bars. That's how you know if longer term traders are coming into the market. Are you getting the big range days? So the long-term trader is not just looking for a fair price in the market. Of course they are, but they're also looking for an advantageous price or an opportunity to trade at. Their mentality is completely different than a retail trader. Retail trader thinks, oh, I got to take this trade because the green arrow appeared, or the red arrow appeared, or we crossed this moving average. The long-term trader doesn't think like that. Generally speaking, the long-term trader is always going to be thinking whether the market is either trading above or below market value. Is the market currently trading where it's valued? Then they don't have an opportunity, right? And again, if you're familiar with market profile, you understand the whole concept of the value area. Where are you trading relative to the value area? Now, the long-term trader doesn't generally look at volume in deciding to trade. They don't think, oh my gosh, we traded this, you got a bar with big volume. I gotta, everyone's coming, I gotta get active. They're already participating in that by working their offers on this move up. But what a lot of people fail to realize is long-term traders actually participate when there's light volume, right? They're the ones that provide the bids in the market when the market's selling off and price is getting exhausted. When sellers are trying to sell more to move the market lower, but it's the big long-term trader that is there to absorb everything. Just as the retail traders are coming in, everyone's buying, tripping over themselves to buy. Market's making new highs. Well, who are they buying it from? They're buying it from the long-term trader. And often at those extremes, you get light volume. Now, another way to look at it is, okay, here, right, we're making these big new lows. As you're making the lows, look at these volumes, 33,000, 35,000, 33,000, 33,000, new low, new low, new low. Then you come down in here, you're making the new low, 26,000, 19,000, 21,000, 15,000. You're making new lows on less volume overall, 26,000, 19,000, 21,000, whereas here you're doing it on 34, 33, 33. Well, do you think this new low is a strong low? Why? You got, even though you got the big negative delta, right, which is encouraging, and you think, oh, we probably make new lows, but overall, the overall picture is there's less people interested in selling down here than there was earlier, right? So it's actually a bullish sign. You still have the buyers there. You still got the guys working their bids down in here, absorbing all this. Here you got 1850, 1824, 1500. That's what's absorbing all this. That's why you got such a big negative delta, is because you got big passive buyers in here absorbing all the selling that's going on. Finally, the sellers are like, I can't do it anymore. You got the small inside day, and you got a big positive delta in here with some buying imbalances. All these people are like, I can't. We're not going lower. Let's cover it, take our losses, look for the next trade, and the market starts trading back up. So for the long-term trader, long-term institutional trader rather, what matters more is managing the position than finding the perfect entry and exit. Short-term traders, they got an advantage actually because they're quick and nimble. They can enter quickly and exit quickly without worrying too much about liquidity. They can wait for a trend to start before they get in. The longer-term trader is trying to catch a trend before it happens, and then ride it once it starts. It's going back to this chart, right? They're buying, buying. Okay, they're getting in down here to catch this trend, whereas a shorter term trader can recognize that we put in this low here. Okay, now I want to get in here to catch this trend. Whereas the longer term trader is, he's not looking at the trend for the rest of the day. He's looking at the trend for the rest of the month in that sense. So being a long-term institutional trader has its own problems that retail traders don't face. Retail trader has no issues with liquidity. Institutional traders' order size is big enough to create liquidity issues when getting into and out of a position. For the long-term institutional trader, already holding inventory, buying into a rising market is going to help him because the current price is going up. He's making money. But, if he's long and looking to get out, he needs to sell into a rising market, not a declining market. Again, that's what I was referring to with the race to the bottom in terms of selling into a declining market. Ultimately what happens is you're going to lose money, whether you're selling coffee mugs on eBay or whether you're selling S&Ps. So don't compete with other sellers. Institutions need liquidity in the market. And it's easier to find liquidity if you're a seller in a rising market than a declining market. Think about it. what causes the flash crashes? Lack of liquidity. The market makers all backed off. The algo stopped. They all shut down. That's what caused the big price swings, right? But in a rising market, everyone wants to buy. Everyone's falling over themselves to buy. In a declining market, if it's what you're looking for, you need the institutions to be the ones buying it to stop the price drop. So where's price going to drop and stop is when you have the long-term institutional trader coming in there providing that liquidity. And like I said, on a rising market, you have a lot of volume because everyone wants to buy. So on a declining market, you tend to have less volume, and it's going to stop when there's, when you get the big buyers coming in. Selling into a rallying market, this is what it looks like, right? You see, look at this, making these new highs, crude oil. Look at these volumes transacting here. Just at each level, you got, this is about 600. Here's 1,000. Here's another 1,000, 1,100, 1,000. You're trading good volume, whereas earlier, you're trading, maybe a couple hundred at each level. So as the market's coming in, rallying rather, the sellers, the long-term sellers are coming in. They're working offers. They're hitting these bids. This is very attractive to them. They're hitting these bids as well. You get that inside bar rather, with a lot of selling imbalances. It's still a bit yummy for them up in here. They're hitting these bids. Finally get it to trade down here. Comes up a little bit. Again, you trade some heavy volume up in here, and it comes down again. You're looking at this. Oh yeah, I got a stacked buying imbalance. I got all these buying imbalances in this bar. Strong delta, strong volume, everything. We're going to the moon. Well, what's happened is you have a lot of people. You have a lot of big sellers offering out supply up in here. You can see that. Look, compare the volume at the top of this bar compared to the volume down here. It's just much thicker up in here than it is down here. So it's telling me that there's, these longer term traders in here offering the supply out. So why is the difference between long-term institutional traders and short-term traders important? It's because the long-term traders tend to trade against the short-term traders, the short-term traders / retail traders. Long-term traders generally don't trade against themselves. I mean, they trade amongst themselves in the cash markets, but in the futures markets, they're not really competing with each other. Short-term traders create market excesses which result in highs or lows that draw in the long-term traders. And long-term institutional traders shift the supply and demand paradigm, which draws in the short-term traders. So what you have is, each one sort of complements each other. The short-term traders are going to sometimes push a market too high or too low, too fast. That draws in the long-term traders. Whereas the long-term traders, by accumulating or distributing a position, are going to attract the short-term traders in. So, they work together in that sense. So when the market's experiencing heavy volume, the long-term traders are showing their commitment and confidence in the market. Forget about the order book, forget about the depth of market. What matters is what's traded. Forget about trying to look there, say, oh, I see this on the offer, I see that on the offer. Oh, this, that. Orders going in. What matters most is what actually traded, and volume is the one piece of market information that can completely change the supply and demand dynamics. A perfect example, coming down in here, boom, stack selling imbalance, make the new low, heavy volume, and then you just start going sideways. You got the inside bar, but what are you seeing down in here? You see positive delta, of course, but you're seeing the aggressive buying coming in here, right? You're seeing it in the volume. Do you see a lot of aggressive selling after this low has been made? No, what you're seeing is blue. Yeah, you should see some reds, but two selling imbalances in a sea of blue. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. 13 buying imbalances versus 2 selling imbalances. What do you think is going to win? And of course, you got the positive deltas to go with it. So the $1 million question is, are longer term traders smarter than short term traders? In some markets, yes. But other markets like individual stocks, I honestly, I doubt it. I have my doubts. Generally, in markets like futures or forex, long-term traders have access to information. The general public just doesn't. In equities, retail traders, I think, have they're more active than commodities. Commodities are you get a lot of, well, I think a lot more commercial activity in there. Now, in equities, when I talk about equities, I mean individual stocks. Retail traders have their own money at stake and can scrutinize all the corporate information about a stock. When you got your own, when you buy your Apple stock, you're doing your own research. Sometimes you let me just say, a lot of these hedge funds, these stock funds, underperform retail traders sometimes. I know a lot of people that work for big firms. Yeah, I'm an equities trader. Well, what's your return? They're shy. I go run to the bathroom, like that. They don't want to talk about it because they think they're smarter than other people. But the difference is they don't necessarily, they think, well, I'm on a conference call with, the CEO, so I have privy to information. But I find that, retail traders, at least in equities, have just as much access to the same information that the institutional trader does. But then when you start going into futures and commodities, when you're dealing against firms that are actually producing stuff, end products, the Procter and Gamble's, the Unilevers that buy the commodity to make something, they know the whole distribution chain. Whereas the equity analysts, again, they sometimes they think that they're the smartest person in the world, and it's a different mentality. But the main difference is long-term traders are the ones who provide a lot of liquidity and start trends. Right, a trend in any market cannot be sustained unless there's institutional activity. So keep that in mind, right? Most of you that watch my courses and trade futures. So that's why I sort of wanted to differentiate the long-term traders and the short-term traders for you, so you can understand the difference. That even in institutional traders, there's long-term traders and short-term traders, and it does honestly, it's not something easy to pick up, and I think it takes time for you to really understand. But I think for some of you, the light bulb will go off. Others, it will flicker. Others, will stay dark. It takes time. Honestly, it takes time to look at a chart and sort of figure out what's going on. I guess the main takeaway from this lesson is keep in mind that in a rising market, you're going to have institutional long-term traders offering out. It's not that they necessarily wait till the market turns to start selling. They're selling on the way up, whereas the short-term traders will wait for the market to turn and then start selling, I guess is the main takeaway from this course. So that concludes Module 2. In Module 3, I'm going to discuss recognizing absorption. What are the early signs it's happening, so you can take advantage of it as soon as possible. So I'll see you on the next module. Thank you, and I'll see you there. Bye-bye.